I'm Greg Hunter. Welcome to USAWatchdog.com and the first interview of 2018. Have a special guest on, brought her back, the author of this book, which hit like number 20 on Amazon. It's in its fifth reprinting. The author is Danielle DiMartino Booth. Danielle DiMartino Booth, thank you for joining us today on USAWatchdog.com.
Happy 2018.
Yes, I know you wrote this book, Fed Up, and here you are, a Fed insider. You worked for Richard Fisher at the Dallas Fed, and I brought you on to give your ascertainment of what you think is going to be coming down the tracks in 2018. And I want to start with the Trump tax cuts. A lot of people think he's going to turbocharge the economy. They're going to bring back trillions of dollars. They're hundreds of billions anyway. I've said the good news is Donald Trump's going to be successful. The bad news is he's going to be successful. It might have some implications for the bond market. But let's just start with what you think about the Trump tax cuts, just to start out your 2018 predictions. How do you think they'll go in 2018?
I wish I could say more about the Trump tax cuts. I wish I could say that something phenomenal had occurred. I was on the front row. I had my popcorn in hand. I was so ready to cut this corporate tax rate. I was so ready to be able to do my taxes on the back of a postcard. And what did the tax cuts do? The tax reform, in quotes, it made it more complicated. Greg, I'm disappointed, and I didn't want to be disappointed because I was the number one cheerleader behind these tax cuts.
Do you think that they'll be responsible? Martin Armstrong was on just a few weeks ago, and do you think that they will bring back, big money? He says, listen, every company is going to bring back money at 15.5%. They're not going to keep it overseas. Do you think that will help turbocharge the economy? Or some reports are saying a lot of this money is going to pay down debt. What say you?
Look, I think that companies have paid forward a lot of the benefits of low interest rates these past few years. It wouldn't surprise me if companies repatriated the funds, trillions of dollars of profits that they've held overseas for years, and paid down the debt with them. Look, the CBO, their assumptions are that these tax cuts will benefit the economy as long as we don't go into recession for the next 10 years. That is a huge, steep assumption. And if I'm Joe Q CEO, Greg, what I'm going to do with some of the money that I bring back on shore is shore up my balance sheet, pay down some of this debt. I might buy my shares back, but with the stock market in the second longest rally of all time, if I can do math, if I can do rudimentary math, I'm going to know that I'm buying back my shares at a very rich, steep price as well. I can't. Yes, the money's coming back on shore. What companies will do with it, it won't necessarily turbocharge, to use your word, the economy.
What do you think about the stock market? A lot of people think it can. Some people are saying we're going to go to 30,000, we're going to go to 40,000. What do you think about your prediction for 2018? The stock market, would you be a little nervous and take some money off the table, or would you charge forward and say, hey, this is the psychedelic shack, and that's where it's at?
A little nervous. That's an understatement. Look, pigs get fat, hogs get slaughtered. That is my absolute motto. If you feel like you can lose the money and if you're going to be in the workforce long enough to make it back, then fine. Leave your chips on the table. But I have always said that the most prudent way to go about your investment is to make sure that you take your cost basis off the table. Whatever you've got invested in the stock market, put it into cash. Let your profits roll if you want. But the second longest stock market rally in all time and the second most overvalued stock market of all time, I mean, it doesn't take a genius to say that this puppy is overvalued and something is going to have to give.
Do you think that people might be selling with the new tax benefits? Do you think people might be selling at the first part of the year? You think we might get a dreadful January because people are going to say, okay, we got a lower rate. I'm going to take the lower rate now. I'm going to go ahead and wait till the first of the year. So 2nd, 3rd, 4th, 5th of January, people are sell. Or do you think they're just going to ride it out?
Look, right now we are riding a momentous wave of momentum. People are in it to win it. The way that you open this particular segment, 30,000, 40,000, all of these numbers are being bandied about because people want for the stock market to continue to go up. Stock market, if you try and short the stock market at this point, you might end up being a pauper. But I reiterate what I said at the very beginning, and that's that if you've got your cost basis still in the market, get it out. Don't be greedy in 2018. Could this thing go on for 6 months, 12 months more? Potentially. Could the Republicans pass an infrastructure bill, which they should have done in January of 2017? Possibly. And would that be a lot more economically beneficial to the economy than the tax reform, so to speak? Yes, it would. So we might have a few more miles to drive before this gas tank runs out of fuel.
What do you think your prediction is? In this time, in late December of 2018, where do you think the stock market will be?
Very hard to say. The European Central Bank, which is the Federal Reserve's peer in Europe, and the Federal Reserve have jointly committed to reducing quantitative easing globally by $1 trillion by this time next year. So by the time we roll around to January 2019, we should have global quantitative easing reduced from $2 trillion a year to $1 trillion a year based on what the Fed is committed to do in terms of reducing the size of the balance sheet and what Mario Draghi at the European Central Bank is committed to do in terms of reducing the amount of purchases that the bank makes. So you tell me, if you take away half of the drug from the patient, if they're going to continue to feel just as high. I cannot see the stock market being as lofty as where it is today 1 year from now.
You think it'll be where it is or lower 1 year from now?
Lower.
Lower in 2018. Okay, at the end of 2018,
by the end of 2018, if the central bankers of the world are truly committed to what they have said, then you're taking half of the medicine away from the patient, Greg. How could it not be lower?
Which brings me to my next question. So let's say we get into trouble. Come June, July, August, we're in trouble. Everything's pointing downward. We're looking like we're in a recession, although, this whole recovery on Main Street, John Williams at shadowstats.com has called it bottom bouncing. So did we really have a recovery? I don't know. We did in the stock market. But let's say they get into trouble. And would they reverse course? If they get into trouble and we start seeing a recession, is Jerry Powell going to say, okay, we'll put some coals on the fire. We'll make sure the Republicans win in 2018. I mean, after all, this is going to be a Donald Trump appointee. Are they going to reverse course and start adding liquidity, QE, money printing, whatever you want to call it, in 2018 if they get into trouble?
Look, Jay Powell is the first person since Paul Volcker ran the Fed who's not a pure academic, who's not a PhD in economics. He has a financial background. He understands the banking system. He understands the shadow banking system. And he's publicly stated that he regrets voting for the last iteration of quantitative easing. I hope that he will not go for the next round of QE just to placate the market, placate Wall Street at the expense of Main Street, as you rightly note. I'm hoping that he is a stronger man than that, because every single paper that's been done and all of the evidence that we've seen over the past decade shows us that QE does a whole lot of nothing for economic growth. Something else needs to be done. And by the way, they haven't raised interest rates enough to lower them. So it's going to take a very strong man in Jay Powell to resist the pressure, as you say, come July, August of this coming year.
What's your bet? If we get into trouble, what's your prediction? More QE or hold tight?
The market would say more QE. I'm saying hold tight.
You're thinking that's your prediction, though. You think Jerry Powell will hold tight?
I'm hoping he does. Look, this is a man who accepted a $1 salary to educate Congress on the perils of the United States government defaulting on its debt. So I'm really hoping that Jay Powell is a strong man. He's got a strong constitution, a stiff spine, and he can push back against the people who say more is more, print, 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 kill the dollar in the end. I'm hoping that he's that person. So in terms of my predictions, we will see, but some of the last words out of Richard Fisher's mouth after he left office was there's one person to pay attention to on the Federal Reserve Board. This is over 2 years ago. That's Jay Powell.
Interest rates. They say they're going to do 3 rate hikes in 2018. Prediction, are they going to get all 3 in?
I'm thinking no. I think that they go in March for sure. This is 2017. If we look back, has been the year of the natural disaster. Mother Nature was not kind. And the flip side of that is that 3 hurricanes and 2 massive wildfires, the largest in California's history, means that a lot of rebuilding has to have occurred. So I think that we will see a sugar high continue through the first quarter of this new year. After that, though, we'll realize that, the automobile industry is still in recession. Wait, consumers' balance sheets are still very shaky. People still can't afford the rents or to buy a house that's out there, and credit card losses continue to rise. So it's whether they get to that second rate hike is, to me, it's a big unknown. For sure, I think they go in March, and then it's to be determined based on the economic data flow and whether or not the economy slows, as I predict it will, towards the middle of the year going into the fall.
Well, that brings me to my next question, and that is, how is the economy going to do next year? Let's just start with your prediction that you think it's going to slow. Explain why you think the economy is going to slow in 2018.
Look, we have seen 24 consecutive back-to-back months when credit card spending has outpaced that of incomes. That tells you that households are struggling to get by. This is not Yves Saint Laurent handbags and Jimmy Choo shoes. These are families who are using their credit cards to take care of the necessities, to fill up the gas tank, to buy groceries that fill up the refrigerator. So we've had 24 consecutive months of credit card spending outpacing income growth. We have seen month after month after month of deterioration in subprime automobile delinquencies as well. And we're starting to see a big tick up in FHA mortgage delinquencies as well from 2009, from 2010. We're almost at 10% in FHA mortgage loans, underlying the sugar high that I just mentioned that we'll see from all of these hurricanes and the rebuilding efforts and the wildfires. Underneath that, still waters run deep. The economy is not doing well, and we are a consumption-driven economy that is weakening underneath.
Would you say the sugar high will wear off in 2018?
Oh, absolutely. Unless you're going to repeat and have Harvey and Irma and Maria and 2 massive wildfires continue to juice the economy and make trucking jobs and lumber prices and everything else that you need to rebuild communities continue to be at raging high prices. That's not how these things work. It tends to be sugar high followed by a hangover.
So you think we'll have sugar high followed by a hangover?
I think I'm mixing metaphors, so shame on me.
No. I understand it. Yeah. No. You come down. I got a headache. Isn't alcohol a lot of sugar? I think it is. Right?
Yes, it is. Happy New Year.
So you think the economy will slow? I mean, you gave a bunch of metrics for that. That's 24 consecutive months of credit cards going up. You think it'll slow? I guess the big question would be, would they go ahead and pull the trigger? I know I've asked this before you again. I mean, it just seems to me in an election year, and Donald Trump has put in Jerome Powell.
The timing couldn't be worse, Greg. The timing could not be worse.
Explain. I mean, they're going to be really tempted to say, okay, we'll start on it after the 2018 election. Right?
Look, last week, I kind of rounded up my 2018 predictions, and what I basically had to say was the Republicans are really hoping that the most optimistic economist forecasts are correct, and that we're going to have the longest economic expansion of all time. The Democrats are praying at the altar of let the recession hit by the summer and by the time the spring thaw occurs and campaign season begins. Democrats are jonesing for a recession. There's nothing better to flip the Congress than a recession that is perfectly timed in front of the midterm elections.
And that's probably what Donald Trump and the Republicans are trying to fight against mostly.
Oh, they're scared as anything.
That's why they got the tax cuts, which is why they're going to say, okay, let the deficit run. Right. Let's go ahead and let's bring all this money back at 15.5%. Trump says he thinks it might be Citigroup says it's at 2.5 trillion overseas. Trump says on the cap trail he said I think it's twice that. I think it's 5 trillion.
Well, but again, companies are not going to bring everything back home that they have overseas. That's unrealistic. with all due deference, because I want this money to come back to the United States. I want it to come back home, and I want for it to be investable in capital expenditures and expanding payrolls and all of the good, warm, fuzzy things that the PR engine suggests that this repatriated income could be. I want for that to come to pass, but that's just not reality.
All right, which brings me to the bond market. Let's see. David Stockman thinks the bond market is going to blow up. He thinks the stock and the bond market will go down at the same time.
Well, they go down together. They're hand in hand.
Martin Armstrong thinks we could get a rotation out of the bond market, and stocks would go up while the bond market goes down. But he thinks
that's fanciful thinking.
Okay, but the thing is that he still thinks the bond market's going to fall on its head. He thinks it's in trouble. Even Cliff High says, we're going to have a little trouble in the bond market with this predictive linguistics at halfpasthuman.com. What about and also, Alan Greenspan has warned about spiking
the bond market bubble. Fancy coming
bubble.
Him, no?
Quickly rising interest rates. Bill Gross talked about it going supernova. Jeffrey Gundlach says buy commodities. I mean, none of that sounds good for the debt market. If you
no.
What? Okay, so
look, Greg, we have gone from $150 trillion globally in 2007 to $220 trillion and counting today. If you delude yourself into thinking that a rising rate environment can be good when we have tacked on $70 trillion of debt in the past decade, you are fooling yourself. It is an accident waiting to happen, and anybody who says it won't take the stock market down with it is just more optimistic than I am by a country mile.
So you think that 2018 is the year of the bond market debacle?
I can't see it happening otherwise, unless, again, the European Central Bank and the Federal Reserve, they all put the brakes on, they back off of their commitment. They're like, you know what, we're going to try and rev up the printing presses again. We're going to try and save the day. But the Federal Reserve has been very adamant about the fact that they've said unwinding the balance sheet, decreasing it by $450 billion per year by the end of 2018 is going to be like watching paint dry, and it will not be data dependent. Rate hikes, future rate hikes are data dependent, but reducing the size of the balance sheet is not. So we're going to continue on with quantitative tightening come what may. So if they back off of that commitment and kill their credibility, maybe the central bankers can come in and try and save the bond market. I just don't see it happening.
And when you say the Fed's going to normalize their balance sheet, that's just more debt on the market. That's just more upward pressure on interest rates, is it?
That's exactly right.
Could you explain that for us? People go, wow, they're going to sell their balance sheet. How does that make interest rates go up? Could you explain that?
Look, before the Fed committed to unwinding its balance sheet, it owned 33% of all mortgages in the United States of America. You cannot tell me that when the holder of a third of all U.S. mortgages begins to let them go and steps back as being the ultimate buyer at any price agnostic, I'll buy it whatever it costs. You can't tell me that if somebody who owns a third of a market steps back, that it's not going to make the price of that item go down. It's as simple as that. The demand is falling.
So you're predicting 2018 prediction for interest rates, bond price. What's your prediction for 2018?
It's really look, Greg. The difference between the 2-year bond yield, the 2-year Treasury bond yield, and the 10-year Treasury bond yield is very sticky. It has been at 60 basis points, 0.6% of 1% for a very long time. Policymakers want for you to believe that they can push long-term interest rates up. The bond market is saying otherwise. And every time we've had a flattening out, a shrinking differential between short-term and long-term interest rates, it has always led to recession.
So you're saying that it's what's called the flattening yield curve when you have the 2-year 0.5% or 0.6% difference between that and 10-year money, or then the 2-year and the 30 years like 1%. So you're saying when that curve gets flat like that, you ding, 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 recession.
Look, the last time we were as flat as we are was 2007, and what followed that?
Recession, a bad one.
Yeah.
So
Debt with less debt. Remember, we've got 70 trillion more on the books today globally than we had a decade ago.
So interest rates, you're saying that interest rates, your prediction for interest rates then up, decidedly up for 2018. Is that, give us your prediction?
I think that the Federal Reserve is going to force interest rates up in March, and that is what we're seeing. But the refusal of longer maturity bond yields to rise indicates that the Fed is going to tighten us into a recession.
Very good. Okay.
I'm not giving you any simple and elegant answers, Greg. I apologize. But it's not that easy. It's not. If you raise interest rates in an environment where you've got way too much debt and way too much leverage, it will pull down under the weight of that leverage the entire economy. And that will pull down interest rates.
So you think interest rates might go down in 2018?
Long term.
Short term up, long term down.
Equals no bueno.
Okay. And Gregory Manarino, TraderSource.net, my buddy, I called him just before this, says, give me a question for Danielle DiMartino Booth. And he says, ask her this. When at the pace they're going, when can the Federal Reserve reduce its balance sheet to normal at the pace they're going? He says, we'll be all old and dead if they keep going at the pace they're going.
Yeah, Greg, I'll be pushing up daisies. Look, they've already stated, before quantitative easing started, the size of the Federal Reserve's balance sheet was somewhere around $900 billion. And policymakers have already stated that they never want to breach the line and have it shrink beyond $2 trillion. So that's $2.5 trillion. But at the rate that they're suggesting that this happens, unless a unicorn flies by my window in about 5 seconds from now, it ain't happening. It's just not happening. I'm sorry. Not at the rate that they're suggesting that they can feasibly shrink the balance sheet by. It's going to take forever.
Oh, so what do you think would happen with gold and silver? Let's just use them in tandem, gold and silver. The prices for gold and silver, have they bottomed? Are they going lower? Are they going higher? Are they going to end up holding their nose and allow more inflation, lower interest rates?
You have settled on the ultimate leading indicator. When gold, which has been flat as a pancake, and silver, when precious metals get off the floor and start to show signs of life, you know that it is time for Katie bar the door. That will be your ultimate indicator, because when the economy hits recession, when the stock market and the bond market and the commercial real estate market and high-end residential real estate, when all of these asset classes hit the soup together, there's only one place to hide, and that is precious metals. So when you see signs of life out of gold and silver, you know you're in the soup.
Oh, well, I was going to get your prediction for real estate, but apparently it's the same as stocks, bonds, real estate. Real estate. What's your prediction 2018?
That's the bear of it. That is what that is the burr in the side of central bankers. It's that when they encourage an everything bubble, when one asset class implodes, it takes all the rest of them with it.
You think that gold and silver will be the last two guys standing when they're
done? Absolutely. They will be the ultimate safe haven, the only place to hide. It's where I'm going to put my mama's money.
Even though it doesn't pay any interest and it's a relic and all that, they've been wanting us to think. And they've been, a lot of people, even Jim Rickards finally.
Look, we're not going on, with all due deference to Jim Rickards, we're not going back on the gold standard. It's not happening anytime soon, but it is the ultimate place to hide and to preserve your capital.
He says that even he admits now that it's been manipulated by the powers that be because they don't want the dollar to look bad.
You know what? I'm not going to feed the tinfoil hats. I'm not going there. I'm just. But at the end of the day, if you're talking about I've worked all my life and I want to make sure that I have a return of principal, not a return on investment, it's the only place to hide.
Okay, good deal. And what about the dollar? The dollar's been since the beginning of 2017. Now we're in a new year. You lost about I don't know 10% or so. It was at 103 in January 2nd, 3rd, 4th, and here we are in January of 2018. It's lost about 10 points. It was down 93 or so around there.
As goes the yield curve, so goes the dollar. Period. End.
So you think the dollar?
This is the third longest expansion in U.S. history. We are months away from being the second longest expansion in U.S. history. If you believe the same people who said that the unicorn did just fly by my window, then this is going to go on for 18 more months, and we're going to surpass the longest economic expansion that ended in March 2001. I just don't buy it. Based on what?
And you would be a buyer of gold and silver right now. You would say, hey, this is not really going to go much lower. You don't see much of a downside from here.
It's been dead money forever. I mean, it's been someplace that you could park your money and watch it go nowhere fast, nor lose.
So you have just treading water, just staying even.
All you're doing is staying even, but I don't think there's downside risk. No.
So if everything happens the way you said, this is one of the things you said in the last interview, which is the reason why it went viral. You told me before we went on the air, you said, wow, that thing went viral. And
it went viral. We went viral, Greg.
Well, you said that, and this is from a Fed insider, you were pretty high up. You were basically right behind Fisher.
I was Richard Fisher's right-hand man.
That's right.
Not quite a man, but yes.
And yes, the right hand, you're the right-hand person.
Yes.
You said the Fed still doesn't know where this is all going to go.
Oh.
You just don't.
Boy, don't you think they want to know? Don't you think they want to know?
What are your? I know you talk to people in the Fed all the time, and you talked to them since the last time we were on, because I'm sure people called you up and said, "Wow, I can't believe you said that." But what are they telling you about where we're going to go? If we have this, basically what you're predicting is stocks are going to go down, real estate's going to tank.
The Fed is the one who is handing out the Kool-Aid on the corner. They believe that they can engineer some kind of a mystical soft landing. It doesn't work like that. It doesn't. They think that they can thread the most microscopically thin, tiny needle of all time and land this economy softly after having interest rates lower for longer than they've ever been in the history of mankind. Good luck with that.
Yeah, and do they know what's going to happen? They know how bad this is going to be. I mean, you brought up that metric. We added $70 trillion on top of the last debt problem we had.
You heard what Janet Yellen said. Janet Yellen recently said that we're in much better shape and we're much safer because we haven't seen the same buildup in debt in the banking system. Look, sister, we've had the buildup in the capital markets. Just because it hasn't occurred in the same exact identical place doesn't mean that the $70 trillion of extra leverage is a fairy tale. It's real. It's out there. It just hasn't occurred in the same place. And that means that central bankers worldwide don't know what the outcome is going to be. They can't tell you what the contagion might or might not look like. And by the way, the Chinese aren't giving us any hints.
And I wanted to ask you about, one of the things that Donald Trump said about the Puerto Rican debt, I know you know all about it, $74 billion, and they went, we can't pay. But that could be amplified by Illinois. California's in trouble. What about...
These tensions speak directly to social tensions that are brewing under the surface. Still waters run very deep. And when you start to talk about cutting public services to the bone, ambulatory services, police, firemen, trash pickup, that these are going to be very, very real issues in places like Illinois, New Jersey, Connecticut, California, and they will be the next generation of politicians' real problem to handle. Now, Greg, now you're getting to the nitty gritty. Now you're getting to why and how central bankers cannot allow and are so afraid of the stock market correcting. Because if the stock market corrects, who on earth is going to have a big enough balance in their checking account to bail out the fourth largest state in the country, Illinois? Who? Nobody.
Could we just how would they handle this coming calamity? I mean, would they just do what Donald Trump said, is we got to wipe that out? Like, that's what he said about the Puerto Rican debt. We have to wipe that out. He wasn't talking about printing money to...
Yeah, and that's really good for our sovereign debt rating. That's fantastic.
Is that... Well, that's Puerto Ricans. How are we going to resolve that? Are we going to print some money for some...
There will be haircuts. There will be pain among retirees. The baby boomer generation is not as secure as it thinks it is. And again, we're talking about pensions in a vacuum. If pensions take a hit, so will IRAs and so will 401ks. You're talking about the second largest generation in the country right now by the number of people. I am not about hyperbole, and I'm not trying to scare anybody, but we will have an elderly poverty issue in this country in the next decade, period, end.
Well, we may have one in the next recession. I mean, that's what you're saying.
That's what's going to trigger it.
I think Social Security is up to 62 million, 63 million, something like that, of people that are.
I think you're thinking trillion.
I mean, 62 million people are on the rolls.
Oh, heavens, yes.
Yeah. So do you think that and we're just talking about pensions, anybody with, so some of these bonds, they're going to have the value cut. You talk about a haircut, which is a nice euphemism. They can't pay it, so they're going to cut the value of the bonds. They're going to cut the value of people's investments, cut the value of people's 401ks. They're going to cut the value of people's pensions, the checks, all that stuff. That's what you're talking about. I mean, that's how they're going to handle it.
That's what I'm talking about. And that's why I'm saying, if you think we have populism today, just you wait until people start cutting into grandma and grandpa's pension checks.
Do you think, so you don't forecast, and I'm trying to drill down here with you, you're not thinking we're going to get this big inflationary pop. I've long said we're going to have inflation and deflation at the same time. What do you say? We're going to have inflation?
Look at lumber prices. Look at the cost of packaging, plastics, raw materials. The producer price index, which the Fed is ignoring at its peril, is at a 6-year high right now. It's called the mother of all margin squeezes. Companies are suffering. We have inflation. We have very real inflation, and it is hitting corporate America between the eyes.
So your prediction for inflation for 2018?
We have seen it happening. We are continuing to see it happening. Look, the cost, personally speaking, as a mother who goes through a gallon of milk a day, it's expensive out there. The healthcare costs. Ask a millennial why they can't move out of their parents' home. It's because rental inflation is off the Richter scale. They can't afford to move out of their parents' home. Buying a home is more inaffordable than it's ever been in the history of mankind. Necessity costs, college tuition, all of these things are egregiously expensive, and yet somehow, miraculously, they're not picked up in what the Fed calls its inflation metrics. Asinine. Sorry.
So you think inflation is definitely, you're calling inflation is up 2018. Inflation up. Inflation
is and has been up. But as you said, we can have inflation and deflation at the same time. Because if you have all of this debt that's built up, especially for households, if they're spending more of their income, if they're allocating more of their paycheck to servicing the debt, by definition, they have fewer dollars to spend on other things. So you're going to see deflation and inflation at the same time. You hit it on the nail the first time you said it.
Inflation and deflation at the same time. That's got to be the worst nightmare for the Fed.
It's a brain twister.
That's got to be the craziest thing you've ever. I mean, it's like usually you get deflation, which is massive debt destruction, like Puerto Rico, or you get inflation, like we had in the Carter years, where the whip inflation now win the buttons they used to hand out. So
and this is as we pursue automation with vigor. So we're trying to replace humans with robots at the same time. We know that we've got we're going to have an echo closure in restaurant chains nationwide. Nobody's talking about this, Greg. The largest contributor to the payrolls of this country has been the restaurant industry in the current recovery. And guess what? They overbuilt to the same extent that retail bricks and mortar overbuilt. And there will be closings, there will be bankruptcies, and there will be layoffs to come in 2018, this year.
And okay, then the last thing, people are sitting here watching, going.
But I promised I promised my glass is half full.
No, I want the truth. I don't want half full or positive or negative. I want the truth. I want to know exactly what it is.
Well, you're in the right place.
Good. Okay, that's fine. And your book, Fed Up. I mean, this is a great. This is the 5th reprinting, so I don't understand why it's being reprinted, because a lot of people are buying your book. I don't mean I get nothing out of. So you folks, I don't get nothing out of pushing your book, but I think it's great. Your book is your hook. But I want to. So, how would you play this? Because people are at home saying, "Let's see, we're going to have my 401k get destroyed, my bond prices are going to get destroyed, my pensions, interest rates are going to go up. I'm going to have inflation and deflation at the same time." What does John Q. Public do to kind of cushion himself and protect himself? Get nitty gritty.
To the extent that you can invest, shore up your balance sheet. Figure out the most economically efficient way to have exposure to precious metals, and don't put your bubble vision on mute. You do not have to be invested in the market. That is a fallacy. Take what you have, pay down your debts. If what I'm predicting comes to pass and you don't have a lot of debt on your books, it's irrelevant to you. You're fine. You're going to ride out the storm, and that's a good thing. But do not listen to your average broker who says that, over the long term, we're coming off of a 35-year bond market rally of magnificent proportions. It is not the safety part of your portfolio. Understand that your bonds are at risk. And if you have to go to the mattresses, I watch The Godfather often, I'm Italian. If you have to go to the mattresses and go to cash, so be it. You want to wake up tomorrow and have what you've earned your entire life still in your hands.
Could we have and while I'm on, I'm just going to keep you over. I'm sorry. I usually try to get done in 30 minutes, but you're just so interesting. Do you think we can have, you're talking about keeping cash in a mattress, so what got me was, do you think we'll have these dreaded bank bail-ins, bank failures, bank holiday, credit crisis?
So
what are you talking about?
Again, this is not going to, look at the Bitcoin mania and ICOs, initial coin offerings. What I've been telling people lately is that we are in 1999 meet 2007. We are in a mania, a speculative investment mania, and we've over leveraged. So marry the two together and decide where you're going to go from there. It's a very tenuous, fragile point in our nation's economy, and I do not envy policymakers at the Federal Reserve trying to navigate the economy through what's to come. The best thing you can do, the best offense, is a great defense.
And what's going to come down to, there's going to be people that's just going to have to lose a lot of money. Right? There's going to be no magic wand where they're going to make people whole in Illinois.
Again, pigs get fat, hogs get slaughtered, and there will be people who think that they can escape by the hair of their chinny chin chin and don't. This whole passive investing, index investing, ETF, look, we know that the size of the entrance is infinity. We have no idea what the size of the exit is. And to your point, Greg, yes, there are going to be a lot of people who get hurt.
The losses. You're predicting big losses. Bonds, stocks, big losses, real estate. That would be that's what I'm hearing. I don't want to put words in your mouth. What I'm hearing is big losses in stocks, bonds, and real estate for 2018.
Again, Deutsche Bank did a seminal report that looked back 100 years. And if you look back over a 100-year period, we have never seen this level of overvaluation across asset classes. This is not my work or my opinion. It's just simply the data. And you don't fight the data.
Record overvaluation.
Record overvaluation.
Does that equal record losses?
We will find out.
Is that would you be predicting record losses with record overvaluation?
Again, the central banks of the world could attempt to print their way out of this again. They could try and buy a fourth round, because remember, this all started in 1987 with Alan Greenspan.
Yeah, 87.
This is when it started. It started 30 years ago. Could we have another decade? I doubt it. I seriously doubt it. But I'm not God. I can't tell you exactly what's going to happen in the years to come, but it's really difficult unless you've been drinking a lot of eggnog over the holidays It's difficult to envision central bankers being able to pull another rabbit out of their hat and buy one more decade.
You would say own your stuff, whatever it is, whatever you have the money to own, your car, your house.
Look, it's time to put on stuff. It's time to put on your big boy pants. This is not you're not in your training pants anymore at all. You have to understand what you own and understand the implications for downside risk. If you're good with that, fine. If you're not, get clean, get out.
All right. Fantastic interview to start the year. The book, which is on her website, Danielle DiMartinoBooth.com. It says Money Strong on it. That's her also a side business side thing, like Solari.com is the Solari report for Catherine Elsie Fitz. But anyway, Fed Up, you can find it on DanielleDiMartinoBooth.com. That'll be in the after the interview section, a link directly to her website, and you can go on there. Also, you also write a lot. You give away free material. It's not just a hawk for a book. I mean, you actually write. You're a pretty prolific writer, and you write articles all the time. And
I've written for about 150 consecutive weeks, a newsletter. I just actually, I have a subscription news service, but you can look back at the top 10 for 2017 for free. So enjoy. Read.
How much is your subscription service, which I get nothing for, just so you know this. We didn't talk about this.
Yeah.
How much is it?
It's not pretty. It's $150 a month or $1,500 a year.
Oh, boy. And then you use all your former Fed contacts and all your economic...
My network is immense, and that it's the biggest blessing that I have is a great network.
I want just one more question. I almost signed you off.
Sure.
One last question. If you were going to sum up what all your peeps are telling you that you're hearing over and over again, what would it be?
It would be that bubbles last for longer than any of us can predict and make poppers out of quite a few of us.
And then are they thinking this is going to, does that mean they think it's going to be going on, or they just have no idea when it's going to pop?
My peeps have quit trying to guess when this is going to end, and that's the scary part.
And with that, we'll leave it right there. Oh, boy. All right, Danielle DiMartino Booth. The website, DanielleDiMartinoBooth.com. The book, Fed Up, it's in its 5th printing. Hopefully you'll get to a 6th printing. I appreciate it. Thanks for joining us today on USA.
Happy New Year, Greg.
Yes, Happy New Year to you. Thanks for joining us today on USA Watchdog.com.
Thank you.